Is the party over? I'm not talking about the New Year's Eve party. I'm talking about the easy monetary policy that the Fed has been pushing since early 2020. Basically, giving money out to anybody who wanted some. It's been fun, but 2022 looks like we're going to have an economic reality check. As the Fed minutes point to a possible rate increase in March, officials are also considering an earlier timetable for shrinking their $8.76 trillion bond portfolio. The Fed minutes are pointing to a possibility of tightening that very loose monetary policy we've had in place since 2020. This started 2022 economically rocky as the Nasdaq fell 5%. And Powell is now stating that inflation is frustrating. We've been talking about this in our videos for quite a while now. I don't know why it's taken him so long to catch up. And the new inflation numbers are coming out on January 12th, and they're expected to be 7% or higher. It was expected that the Fed would start tapering their bond purchases by the end of March. But what threw the markets into a fit is they also announced their intent to unwind the balance sheet. The last time they attempted this was 2018, and markets reacted very poorly. They dove, forcing the Fed to reverse course in less than a year in 2019, lowering interest rates and pumping money back into the economy. Let me highlight that in 2019, when the Fed reversed course, the economy was very different. Inflation was only at 1.81%. So when they flooded the markets again with money and low interest, it didn't negatively impact the economy the way it will today. Further tying the Fed's hands, the jobs report just came out, showing that unemployment rate falls below 4% for the first time since the health crisis. The unemployment rate fell to 3.9%. Low unemployment, that's a good thing, right? But these are not typical times. As the New York Post reports, a sorry bid to spin December's weak jobs report. Why do they need to spin the jobs report? U.S. added just 199,000 jobs in December. It's difficult to understand what all this means. Low unemployment, and yet we're not adding a lot of jobs either. Why is this bad? Its perplexing jobs report raises concerns about absent workers, because it's not just the unemployment numbers that matter. What really matters is how many people are not looking for work. As you can see from this chart of labor participation rate, the number of people actively looking for work is still well below 2019 levels, and people not looking for work are not considered unemployed. The reality is there's a shortage of labor. All you have to do is go out and try to get service anywhere, and there's a shortage of hiring. The Fed is choosing to look at the numbers to validate their position. I was joking with a colleague of mine that in an odd way, the Fed, without even realizing it, is helping fight inflation by raising the cost of living so high that it's forcing people out of retirement and back to work. The Fed seems intent on tightening monetary policy to fight inflation, and in their view, they're using the jobs report to validate their position. Jobs report likely keeps Fed on track for a rate raise in March. The key takeaway is that the Fed has been getting it all wrong since 2020. They've called for more stimulus even though inflation was showing, saying it was transitory, held that position all the way through 2021, And now, as they're talking about raising rates and tapering and unwinding the balance sheet, they're making that decision using old economic models that don't work in this situation. What's going to happen is we're going to see a lot of market volatility as the Fed moves are going to be consistently wrong. It's really important to stay informed. Make sure you subscribe because we got a lot more to share with you.